All right, let's get right to it. The Federal Reserve just made its move and cut interest rates for the first time this year. So let's break down what that actually means for your money.
So here's the headline number. The Fed has cut its key interest rate by 0.25%. The new target range is now sitting between 3.5% and 3.75%. Now, that might not sound like a huge number, but trust me, it signals a major shift in policy.
But let's be real. What does any of this actually mean for your money, right? How does this decision hit your savings account, your credit card bill, your investments? That's exactly what we're going to break down right now.
Okay, so to figure out where we're headed, we've got to first look at how we got here. Because this rate cut was anything but a simple, unanimous decision. It was actually pretty messy.
You're going to hear this term all over Wall Street, a hawkish cut. And yeah, it sounds like a total contradiction, right? But it's actually the key to this whole thing. It basically means, yeah, they cut rates, but they did it while sending a huge warning signal. They're telling us they're still super worried about inflation, and don't expect another cut anytime soon. And this really shows you just how split the Fed is on this. I mean, look at this. You had the majority voting for the small cut, sure, but you also had some members who wanted to do nothing at all, and then one governor who wanted to go big with a half-point cut. That's a serious disagreement. It tells you nobody really agrees on the right path forward.
So why all the drama? Well, it's because the Fed is stuck in the middle of a massive economic tug-of-war. They're looking at two key pieces of data, and these numbers are pulling them in totally opposite directions.
Okay, so on one side of the rope, you've got the job market, which is starting to slow down. That's screaming, cut rates, help the economy. But then on the other side, you've got inflation, which is still way too high. And that's screaming, whoa, hold on, don't you dare cut rates too fast. Let's look at the actual charts.
First up, here's the argument for cutting rates. This is the non-farm payrolls chart, which is really just a fancy way of saying job creation. And you can see it plain as day, that clear downward trend. This is the #1 reason the Fed felt like it had to do something.
But then there's this. The counterargument. Inflation. It's still hanging around 3%. That's a full percentage point higher than the Fed's 2% target. So you see the problem, right? The job market's weakening, but inflation is still too hot. And that is the tightrope the Fed has to walk.
Okay, so that's the conflict right now. But what about the future? The Fed gave us their official forecast. But the market, the people betting with billions of dollars? Well, they seem to be telling a completely different story. So according to the Fed's own official projections, they've only penciled in one more rate cut for the entire year of 2026. Just one. That's their official line, and man, is it cautious.
But the market doesn't care about a year from now, it cares about the next meeting. Traders are placing their bets as we speak on what the Fed's going to do in January. So what are they saying?
And here it is, the big reveal. This is from the CME Fed Watch tool. It tracks where the actual money is going. Traders are pricing in a whopping 75.6% chance that the Fed does absolutely nothing. They're betting that this hawkish cut was a one and done, and the next move is just to sit tight.
Okay, let's bring it all back to what really matters. With this cut, the split at the Fed, and what the market is betting on, what does this practically mean for your wallet in 2026? All right, here are the key takeaways for you. Number 1, borrowing costs. Think credit cards, personal loans. You can probably expect those rates to get just a little bit cheaper. Number 2, your savings account. Those amazing high-yield savings rates we've been enjoying? Yeah, they'll probably start to dip a little. And finally, number 3, the bond market. The outlook here is actually pretty positive for 2026 because lower rates tend to make existing bonds more valuable. And I want to leave you with this quote from the Fed chair himself, Jerome Powell, right after he made the announcement. He said, "There is no risk-free path." And that really sums it all up, doesn't it? The Fed is walking a tightrope between fighting inflation and protecting the job market. What they do next? Well, it all depends on which of those two economic forces pulls the hardest.